All right, good evening, folks. I wanted to jump in here and get something before the weekend relative to GDX. I'll do the rest of this stuff over the weekend, but GDX is breaking out. Let's see, it confirmed with a second day close today, but I'm watching it. A lot of times these breakouts, they return to the scene of the crime, or what's known as they come back to the breakout line for a test. It's just hard to know. So let's jump into what they did. So GDX, the underlying, was trading at 35.28 and moved up almost a dollar, 36.27. So it was up 2.81. Oh, we were down minus 2.5. Well, if you looked at that naively, you had to take into account, okay, that this is ex-dividend day, right? So we had the 80 cents, the 79.78 that the fund paid taken out. So we actually moved up. I didn't calculate the percentage, but you can do that, right? You can come in here and say 1923 minus 0.7978 from memory. What did that give us? Oh, I have to say equals the sum. Sorry about that. Okay, that says we should have been at 1843. Okay, so hard to know. I can tell you right now we probably didn't perform equally, and I'll explain. So that said, we were up 32 cents, and 32 cents on $19 versus almost a dollar on 35, we would have been a little underperforming. And that makes sense. But I hate it when people aren't aware that ex-dividend is taken out. I mean, I know you know if you own a lot of Yieldmax funds, but that's why I color-coded and put a little red there. I don't want to change the real value. I just want to make a note of it. So anyway, let's take a look at the trades that they put on. So because money also flowed into the fund, because it had really broken out on 7/3, we had the holiday on 7/4, and then people are buying into the fund, right? So they bought 50,000 shares one day, and they turned around and bought 50,000. We had not had any buy-in to the fund until way back on 6/3. So this is getting noticed, and many of you that know I was talking it up when it opened as having made a lot of money and retired early, playing the precious metals mining stocks and just how super undervalued they are, even relative to the metal prices. And then silver is so undervalued relative to gold, and copper had a run and is pulled back. But these commodities, it takes a lot of energy and labor to extract them. The more we need them, the higher they will rise. You always have this boom and bust cycle for things that we consume. Lumber, agriculture, you know, I call them real things. You can't print them. It's not like fiat money. You can't run out and just print a bunch of gold or print a bunch of silver or print a bunch of copper, right? These metals are needed industrially. Gold has little industrial value, but most of the other metals have a lot of industrial value. So anyway, let's go forward on this. So what happened? Well, they took that money and they deployed another set of synthetics and calls. So on the calls, they wrote 235, okay, at the 37 strike. Now, I'm not a fan of how they're doing this, but you know, typical fund managers, they're not trying to analyze, oh, this may be breaking out. I mean, they write a prospectus that they're going to write, you know, 5% to 15% out of the money on the weeklies. And so, in some fairness, they stick to that. Now, it doesn't take a rocket scientist to see that the IV will go up if this thing starts blowing up and runs to 40, 45, 50, 60 over the next couple months. Am I saying that's going to happen? I hope so. May not, right? If I knew that, I would own a lot more options and I would own the underlying completely. I do own some GDXY, but I do put my own options on at times for some of the underlying miners owned in GDX, right? And this is a mid to large cap, so these are some of the largest mining companies in the world. And I'll go into some details from time to time for my subscribers, but in general, I'm just talking about the Yieldmax fund. So they wrote another set of 712s. That, you know, on 7.3, they had rolled out of their previous one and they wrote a 36. Well, guys, it doesn't take much to see that 36.27, they're already in a losing situation. So on Friday, they wrote 1 week out the 37s. Again, their focus on the weeklies is to get as much income as they can by being a little out of the money. But sometimes you got to realize what the potential is, and I'll show you more on that. So anyway, the net is they collected money, but now we have a losing position here, and I'll show you that. Let's go look at the synthetics. Those are a winner because with 719 just being 2 weeks out from today, we were able to collect more money by writing 38s. Is it possible we'll be at 38? We could well be by 719. Then we really start making money, right? Because all this money where we've written the 38s and collected the money and had a liability, I left this here on purpose. So the last time I updated this, it was 782. Wait till I show you how low it is now, right? It's 300 and something. So I'll go back and update this later. But these values, right, the puts are much, much lower because we're closer to 38 at 36.27. Okay? And the calls go up in value. Again, we're close, so this has to happen. I'm not saying it absolutely will, but it looks pretty good at the moment. So let's take then a look. So that's what we did here. We put another 35,000 in our kitty, right? So we now have, just for July, 75,000 on our synthetic. And remember, this is low amount of shares, so that would seem like a very small amount of money for an NVIDIA or a Coney, even a Misty, right? With, you know, Misty's got 11 million shares, Coney's got 30-something. Coney's got more shares than NVIDIA does. Last I looked, I think NVIDIA had around 28 million shares. So let's take a look on the weekly. So here's a summary for us. And what I didn't add is the 235, right? So we have 235, and those are now at a 37. Which is pretty close with 5 trading days to go. Okay, so we're 4.88 out. Whoops, gotta update this guy, Bruce, and now you'll see where we're behind. All right, so we're behind 0.74 here. And we're only 2% out of the money with a full week of trading for next week, right? So this is reflecting, sorry, that isn't. So remember, we had the money come out of that, right? It had been 1923, but we had to deduct roughly the 80 cents rounded. So what I wanted to show you here is this hit 36. I didn't update the chart. Sorry, this was the breakout on 7.3. We confirmed the breakout, and we're now at 36.27. But a lot of times these guys, now I can't tell you where it's going to go Monday. It could gap and run up to 38 or 37. It also could, come back a little bit, or we could have a pull back to, 35. So what we want as holders of GDXY is we want it to come back a little bit, or maybe it runs up here and then it retraces, because we always want to win our weeklies when we can. The synthetic is sort of going to take care of itself. Because I'm bullish on the precious metal miners. So again, I don't update these charts. It takes a lot of time to do all of this. So every few days or something important, I'll come through and update the chart for you guys. All right, so let's go over to holdings because this sums it up for us in a better way. So look at that synthetic, 365, right? We had a 700, 572, 712, 715. We had big losses there that all it takes is some momentum. Remember, if we go to 38, the put goes to 0. Look at what the put is right now. The put's 431,000. So if we get there in a week, all of a sudden, this is a positive number, right? Instead of a negative number. Now we start making it on the synthetic. So what I want to see from the fund managers is I want them to recognize this bull market and go out there a little further. I don't care if they get a 1% yield instead of a 2% yield here. I want it to allow for the ceiling to go if these are running, because look what it's done to us, right? Small amount, but now we collected, I think, 35 cents, and now we have a 74-cent liability because we ran right by that. Now, again, the way you solve that is you pull back below 36, high 35s, and then you have 4 trading days, and all of a sudden this thing comes down to 50 cents here. So, you know, the yin and the yang here. And look at this, 13%. Well, the other 50,000 was like almost 15%. So the larger your base is, the less. But we're adding shares. Why? Because people are seeing this. So anyway, fair value is showing 1875. We closed at 1873. So now they've paid, you know, they've allocated the money out of the fund that they're going to pay you on Monday. So, you know, we're getting back to normal past this ex-dividend day. All right, let's go to the payout. Let me wrap this up for you guys going into your weekend. So the situation is we've collected a total of 36 cents early on, and 18 cents are in our short call income. Although that can change, right? If we go to 37, 38 this week, you know, that 37 could become in danger. So all of a sudden we could have a loser. But what that would do over here is make us a lot of money. But again, I like the gain to be, you'll figure out on these Yieldmax funds that whatever they're writing the weeklies at, and it's never going to correspond to that. You want a slow, steady gain. That way your synthetic is making money. Because remember, the synthetic is nothing but a pair of options that mimic being long the stock. The higher the stock goes, the more money you collect over here in your synthetic. But this short call income can actually drag this down. And what I mean by drag it down, if we ran to 40, we'd have a huge liability to buy them back on the weekly, and we would have all the money over here. But who wants one where you make a ton of money on the synthetic side and you lose a ton of money in the short call? That's why funds like NVIDIA and other ones, when they're really running, you're like, well, why is NVIDIA with that massive move up only paying $248? Well, because it overruns its synthetics, it overruns its weekly calls a lot. And that has a pretty high IV, so it's really the yin and yang, and I'm going to do an anatomy of a NAV reduction video to just dial it in for you guys so you can see exactly what's going on in one of these high flyers. And so it's still good, but there is some validity to the fact that it's better to own the underlying. It's only better to own the underlying when it's high flying and it's running. And I would counter that to say, if you know it's running and really moving up, why bother to own the underlying? Own a 2X, right? Because the 2X is going to outperform. But 2Xs aren't good to hold for a long period of time because they decay quicker. And the way they're generating 2 times. So a lot more videos for you guys to dial this in for those that want to actively manage it. If you just want to sit back and collect decent yield, you'll do that in GDXY. Going forward, you'll get a good yield. But all of these funds are vulnerable to running past their weekly calls, and they're truly naked calls. I know, everybody calls them covered calls. They're not. It's a covered call strategy. I don't know how many times I have to say that. Because there are funds that truly own this underlying stock and write calls. So those really are covered call ETFs. And I like to differentiate, right? And in Ulti, for instance, we use a covered call strategy. In Ulti, they own a whole bunch of stock, and they write weekly covered calls, and sometimes they get called out, and sometimes they keep the premium. And that's truly a covered call ETF. Okay, guys, again, this is not financial advice. I'm not a financial advisor. Okay, this is Bruce out. Have a great weekend. Bye.